Hello, and welcome to this month's investment briefing, brought to you by Gemini Asset Management. In today's video, we'll cover market performance, investor perspective, and the outlook from here. Let's start off with market performance. There's lots of uncertainty out there, but to put a finer point on a few broad topics, 2022 so far has seen the Russia-Ukraine war, global cost of living crises, continued supply chain issues, COVID-19 lockdowns in China, global economic growth slowdown, and a substantial paradigm shift in the major central bank policies with increasing interest rates and the removal of monetary support within major economies. All of these events have typically led to increased levels of volatility in asset markets and broad price declines across many different asset classes. Figure 1 on screen now shows how the performance of a typical 60-40 portfolio, which represents a portfolio that holds 60% in global equities and 40% in global bonds. This highlights two key points. The first point is that it is possible to actually lose money in any given year. Of course, this isn't the goal, and as you can see, most of the time, markets have posted positive returns. But it is always worth bearing in mind that it is actually possible to lose money whilst investing, and the risk of this must be respected throughout both volatile markets and during positive periods. The second point to highlight in Figure 1 is that usually when equities, stocks, are down for the year, shown by the green bar, bonds perform positively, acting as a ballast to portfolio returns to mitigate some losses. This hasn't been the case in 2022 so far, given the specific concoction of market dynamics we presently face. In fact, in the last 30 years shown in the chart, there's only ever been one other occasion when both equities and bonds have posted negative performance. Which moves us on to our next topic, investor perspective. Even though negative performance is an inevitable part of an investor's journey, it's important to maintain an appropriate perspective, which has proven to be quite difficult so far in 2022, and is well encapsulated here in Figure 2. Barring the COVID-19 market crash in 2020 and the sentiment so far in 2022, asset markets have experienced their longest and most prolonged bull market ever, which is just an industry term for positive sentiment and market performance. Even the COVID crash of 2020 only lasted about a month or so before markets began to essentially recover exceptionally strongly. So it's understandable that investors have become used to seeing positive performance even in the face of extreme levels of uncertainty for markets. But it's always worth remembering the old adage that past performance isn't a good predictor of future performance. So Figure 3 on screen now shows just how difficult it's been to make any money so far this year. Figure 3 shows the total return generated by different investment association sectors. Each sector represents the average return generated by the funds aggregated within it. So, global government bond funds, typically a safe haven for investors during difficult times, have lost an average of 6% so far in 2022, and the average UK equity fund is down 12.5% too. Figure 3 shows that unless a portfolio were heavily concentrated in sectors which have returned positively, like commodity or infrastructure equities, it would have really struggled this year. Only 4 out of 43 sectors had generated any positive return, and one of those was cash, which essentially made nothing. At a time of poor market performance almost across the entire board, there's always a temptation to panic and make drastic changes to portfolios or risk profiles, which can often be a costly mistake. Figure 4 on screen now shows the performance of the MSCI World Equity Index since the end of 2019, which includes the COVID-19 crash and, crucially, the strong rebound that followed. If an investor panicked and moved out of their risk profile portfolio and into cash after the market crash, then they would have missed out on a great deal of positive return achieved throughout the rest of 2020 and 2021. This highlights an important point, which is that risk profiles are there for a reason. Risk profiling is designed to ensure that investors' attitude to investment risk is assessed and matched to a portfolio, which is in line with their circumstances, their ability to tolerate risks, and their capacity to bear losses that may occur during the investment journey. Short-term market volatility and negative market movements are inevitable during any medium to long-term investment period, and risk profiling helps to ensure that investors are prepared for these. Figure 4 also shows that market recoveries can happen very quickly. It's often the case that the largest rebounds in positive market performance come soon after the largest drops, and if an investor were to move to cash during this time, their long-term returns may have been negatively impacted. But investor perspective isn't always bad news though, and it's nice to finish on something a little bit more positive. So here goes. Figure 5, which is on screen now, shows the aggregated corporate margins for different equity indices. And as you can see, so far, profit margins have remained strong in most regions, and the heavy sell-off of some of the businesses so far this year may provide a positive opportunity at some point in the future. Now, of course, this doesn't mean that there'll be no further price declines. There's always a risk, and this has to be acknowledged and respected. But just like the strong market bounce after the COVID-19 crash, at times of high uncertainty, there may be opportunity. And here at Gemini Asset Management, we'll continue to apply our rigorous, tried and tested processes of investment management to try and continue to hunt them out. With all this in mind, we hope you found this video useful and that you may feel reassured through what's been a difficult year, both on a humanitarian and a financial front. If you have any queries or wish to discuss any of the topics that we've covered today, please reach out to your Gemini Wealth Management financial advisor. Take care, and we'll see you again soon. Thank you.